Hello everyone, I do hope you're enjoying your day at the Sydney Home Buyer and Property Investor Show. I'm Paul Chris from Resi Home Loans and I'd like to welcome each of you to the Lounge with the Experts today. I now have the pleasure of introducing Brad Beer. He's the Managing Director of BMT Tax Depreciation. In this session, Depreciation Made Easy, Brad will explain what depreciation is, its benefits and how it saves investors thousands each year. Please welcome Brad Beer.
Thank you, Paul, and thank you, Resi, I guess, as the sponsor of the lounge. Well, Brad Beer is my name, obviously. I've been with BMT for about 15 years. I run and own it with a couple of other guys. What I'm going to do today is really just give you an indication or talk to you about depreciation as investors and what it means to you, what difference it makes to the cost of owning a property. Pretty much everyone's here today related largely to the fact that, we're at a property and investment expo. You're probably thinking of investing in property, or you're already investing in property with probably mainly the purpose of making some money from that property, I assume. Other than it's just like you like to do it for fun. But predominantly it's about making some money out of that property. Depreciation makes a big difference to the amount of money or cash flow from that property. Something that most investors, when they buy properties, don't really understand very well. I still, in the last couple of days here, have spoken to so many people that have no idea and have owned property for some period of time, and it makes a big difference. We're going to talk about the difference and how much of a difference it makes today. And a little bit about how we actually do depreciation, why we do depreciation, and some tools to help you crunch numbers when you're buying property, because you need to know these numbers before you buy it, not just after later on probably. You probably should find these things out a bit more up front a lot of the time. And a lot of people do. A lot of people do know about depreciation, but not as much as probably should, considering the number of investors in the country. A little background on BMT, as I said, I run and own it with a couple of other guys. We're a national business. We have offices and staff spread around the country. There's about 165 staff in total. And what we do is depreciation schedules and specialise in those, and that alone pretty much, and just help to save investors a bunch of money. And before we get into that, just really quickly, BMT Tax Depreciation Quantity Surveyors. A lot of people say, what do you do for a job? I say, oh, well, depreciation schedules. I'm a quantity surveyor, and people go, what on earth is that? I did a building degree or a construction management degree, as have a number of my staff. Out of that, you come out as a quantity surveyor. So I can get involved in construction in different ways as a construction management degree person. A quantity surveyor is someone who measures and estimates the construction costs of buildings. So we get the plans of a building and measure how much concrete, how much steel, how much carpet if you like, how many beams, how much roof, how much of everything is in there, and how much should it cost to build that in the current market. That might be before it's built, so we can see whether or not you can build it. Might be after it's been built, might be while it's being built. For depreciation, most of the time it's after it's been built. It all relates to, a quantity surveyor is someone who measures and estimates how much something should, would or did cost to build. So the quantity surveyor. Why we invest in property is about making money. The ways to do that: minimise your interest rates where possible. Maybe Resi can help you with that as the sponsor today. Thank you, Resi. Minimise the expenses in relation to owning that property, but you have to pay the interest. You have to repair and maintain the property. You have to pay your rates and all those things. You can't control a lot of that. Fact is, you've got to do it. The other thing you need to do is actually make sure you claim all your tax deductions properly. Depreciation being one of those tax deductions. Not all of those tax deductions, one of them. Around 80% of investors are not claiming it properly, meaning you're just missing out on money. You keep it, leaving it with Kevin Rudd for him to spend. Why do that if you're allowed to have it legitimately? It's not Kevin that spends it, but it's the team of those. So we can help you out with that one, and we'll talk about that today. What is it? Hidden cash flow for property investors. Building's getting older, it's wearing out. So one day the carpet's going to wear out, one day the bricks are going to fall over, I suppose. One day the property or the house itself is going to, wear out and fall over in some way. So the tax office says that based on that, if it's an investment property, we're able to claim a deduction that relates to part of the cost of that construction of a property each year. So we all talk about property appreciating in value because that's part of the way we make money and we want that to happen. But the fact is the building itself, the carpets, they're going to wear out one day. You're going to have to throw them away eventually. They're not, the carpet that's 10 years old is going to be worth less than new carpet. I can assure you of that because it's got wear and tear on it. The tax office says because this wear and tear relates to an investment property, we'll allow you to claim part of it as a deduction. Investment properties only, not your principal place of residence. You can't claim depreciation on your house when you live in it. Similarly, you can't claim your interest on your house when you live in it. Same sort of thing. Needs to be an investment property. But house, unit, shed, this building, industrial property, whatever it is, if it's an investment type property, you get to claim depreciation. A few weeks ago, we did the big rocking horse in Adelaide, a depreciation schedule. Rocking horse, it's used as an investment because it's a big rocking horse, a bit like our big oyster, prawn and whatever else we have around this country. They're an investment property still, so someone wanted to claim their depreciation on that and we did it a few weeks ago. Interesting. Now, I think the easiest way to give you an indication of what it means to an investor if we claim or don't claim, sorry, I'm going to have to sit in front of someone in these things, but I'll try to move a bit so you can see. Give you an indication of what it means to an investor is to run through a simple scenario of a property and say, what happens if we claim depreciation? What happens if we don't claim depreciation? What does that do to the cash flow as an investor? I'll take a simple unit here. Now, whatever the investment property you buy is not my decision or not something I get involved with. What I do is help you depreciate it afterwards, but give you some numbers up front early on what it might be. We're going to take a simple scenario here. Let's say we've got this unit. We bought it for $450,000 a week. We're going to rent that. We're going to get as much rent as we legitimately can, of course. We can't ask for $600 a week if the market pays $440, can we? I'd like to, but you're probably not going to get it. It's going to stay vacant. You're going to get nothing. $440 a week, let's say that's what the rent is. What that means is you're going to get an income of about $22,880 per year if this property is full all the time, which is good. Not so good when you've got to pay all the expenses out because you've got to pay the interest back to the bank or they're going to come back and take the property. You've got to pay out the rates, the management fees, all those expenses we talked about. You've got to pay those out. Let's say that's about $38,000 in this scenario. Not great. You've got to kick in $15,120 a year or about $290 a week, $91 a week to hold on to this property. It's not fantastic. It's a few bucks out of the pocket. Fair few at this stage. Does get a little bit better than that. Even if we don't claim depreciation or do it properly, the tax office allows us to make a deduction for that loss against our other income. Okay? So we've got a $15,000 loss there, $15,120. If our marginal tax rate that we are using this other income, this deduction against is 37%, which is most common for investors in this country, we get a refund then of $5,594 at the end of the year. Our cost to own the property now for the year is $9,526 or about $183 a week. So it's a bit better. 291 comes to 183 by making a simple deduction for our losses. If your property is positive before this, it changes the numbers depending what your rent is and all those things, and what property you buy changes all these numbers. I'm just using a simple scenario here to show the difference if we do or don't claim the depreciation. $183 a week it's going to cost us. Now, we have a look at this property and go, what sort of depreciation are we going to claim, which is what our part is as the depreciation guy. We believe the deduction will be about $15,500 in the first full financial year for depreciation. Building older, getting older, wearing out, we get to claim a deduction for that. What that means is we're going to make a $15,120 for the expenses we paid out deduction. We're going to make $15,500 in depreciation deduction. The difference with this one is it's a non-cash tax deduction. You don't pay it out this time. You are claiming it because the building's getting older and wearing out. It's not something you pay out each year. We make a $30,000 deduction, $30,620. We get $11,329 back at the end of the financial year. Our outlay for the year is $3,791, or the cost to own this property $73 per week. Claim depreciation, don't claim depreciation, $110 per week difference in owning the cost of the property. Many of you are not doing it properly, not claiming it. I don't know why I still speak to investors every day that don't do that, because it's there. It's been in the rules of the ATO rules for some time. Makes a big difference to the cost of owning it. Now my job in this scenario, I'm not your accountant, I'm not your guy that tells you to buy that unit or anything else. I just work out this number over here for you and try to make it as high as I obviously legitimately can. We want to make it 15,500, not 10,000, not 5,000, not whatever it is. Okay. Claim it, don't claim it, make sure. Sometimes it's guessed by you, or sometimes the accountant makes a guess or something along those lines, and they might say 10,000, or someone who doesn't know how to do depreciation schedules properly says does 10,000. You want it to be as much as possible because it makes a big difference, the cost of owning the property. We got $440 a week rent out of this property. See if you can get 520 in the current market. It'll be vacant. You'll get nothing. You can't do it. It's really simple.